Rohr here with an early global view on Tuesday, February 3rd, 2015. It's currently 7 a.m. U.S. Central Time, and there is one key global macro factor this morning that's explaining a bit of how the various markets are acting, and that is the somewhat surprising rate cut, although not a total shock, from Reserve Bank of Australia. Lowered its rate 25 basis points to 2.25%. We'll be back to discussing that in a little bit. So, what does all this mean to the markets? And quite simply, with the U.S. S&P 500 hourly on the left, 30-minute on the right as usual, what we can see is that after the very weak activity on the weak U.S. durables, after very weak earnings and even negative guidance from the likes of Procter & Gamble and Caterpillar, international heavy machinery company, the market recovered, failed from up at the 20, 36 to 40 area in spite of good earnings from Apple, actually outstanding earnings from Apple, Tuesday afternoon. Wednesday morning, the market couldn't get back above there. And even in the wake of a still accommodative Fed, it couldn't do it. So it came under pressure later on last Wednesday, bounced all day Thursday in anticipation probably of that U.S. GDP. And when that didn't come in as well as expected, it came back under pressure. All of which made for a couple of tests of that key 1985 to 78 range. In fact, on the opening on Monday, maybe just technical factors spilling over and still some worries about the situation with Greece and Europe, where we ended up was slightly below 1978 into this trading low at around 1975, but then quickly back above it and stabilizing. And ultimately there was an announcement from the Greeks that rather than a sheer headline write-off of their 315 billion euros of debt, they were interested in swapping it out, which, if any of you missed it, we had a commentary post over the weekend that Syriza, the new anti-austerity left-wing party in Greece, is Germany's just desserts for pushing a too aggressive austerity program. And it seems like there's a more creative evolution going on, and the equity markets, all of them, like that a lot. And of course, that leaves us pushing back above this failure area, back around the old 2013 to 16 range we've highlighted on quite a few occasions. And in fact, this morning, we're up another 5 at 2022, and we've been up around 2027 or so at the highs. So now we have to see how the situation in Europe develops, but also the ongoing data this week. Today actually is a bit of a light data day. We get out into the European and global services PMIs tomorrow, along with other important data into Thursday. So it's going to be very interesting that way. And the higher resistances here, of course, are around 2025, historically, and again up at 2036 to 40. Now maybe with a buffer to that congestion up in the 43 area. Lower supports would remain 13 area, down around these various false up breaks and failures around 2002 to 1998, and of course ultimately back down in the 1985 to 78 range. The other important factor we note here is that by later on yesterday, the S&P 500 saw the short-term, the hourly MACD, pull up above the lower runaway band in a more meaningful way than it did on the recovery Thursday evening, or even in the midday on Friday, and therefore that probably leaves it underpinned a bit better for a squeeze to higher levels. Question now is going to be whether it can escape the upper runaway band, and we'll be keeping an eye on that. That pretty much does it for the short-term view of the S&P 500.